Hi, welcome to this new video. So today we are going to learn about flip zones. So let me explain what are flip zones through live examples on price charts. So here we have in front of us the daily chart of HDFC. So far we have been learning about demand zones and supply zones. So for your benefit, let me first revisit them. So we can see that this particular zone was rally, base, drop. If I draw from base to wick, this was a supply zone. This we already know so far. So price dropped from there, entered here, first time back, and then retraced. So this is our flip zone. This is our supply zone. Second time back, again, it came back. Third time back, minor retracement, and then it finally broke this day when the zone got violated. Then price somewhat went sideways over here, and then it moved up, back up there. You can see this, right? So here we can see that this is how normal supply zones work. And we also know how normal demand zones work. So for your convenience, let me draw this demand zone in front of you. This is a rally-based rally demand zone. So it should be green in color, right? So this is price went up back in here, came back here. This is the first time back and reacted to it. Second time back, it broke the zone. So now let me draw a special zone for you. Can you see this particular supply zone over here? Right, so this, as per what we have learned, is a rally, a single base candle, and then drop, and then move out from there, right? So this, as per what we have learned so far, is definitely a supply zone, right? Now let us see what happened to this supply zone. So price came back to this supply zone, reacted little bit from it, very minorly, came back to this demand zone, and then went up and broke this supply zone, right? Then see what happened to this supply zone. So once it broke, price returned back to this zone from the opposite side, right? It bounced from here first time. Second time again it bounced from here, and then it moved up from here. And this zone, which was previously a supply zone, you can see now it behaved as a demand zone. So there was change of nature of this particular zone. So such type of zones are called flip zones. So since once the supply zone broke, its nature changes. It now will behave like a demand zone, so we'll change the color to green. So once price breaks it, it returns back, and this supply zone now is acting as a demand zone. Price first time back, second time back, and it moves away from it, right? So this is a very simple example of how a flip zone worked over here. This was the first case. Let me show you one more flip zone which I can see on the chart right now. So if you see this particular supply zone over here, this was a rally, single base candle, and then drop from there. Price went back in there, dropped slightly, then went up, and on this day, this was on 4th of November 2019, it broke, right? The next day price gapped up, came back into the zone, and then moved up from there. So now this supply zone acted as a flip zone over here, and it behaved now as a demand zone, right? So initially it was supply zone. Once a supply zone breaks, it can act as a demand zone. Now this is what we call a flip zone. So it flips from demand to supply, and even in the vice versa cases, from demand to supply. Here we have seen supply to demand. You can also work in this opposite direction. That is, it can become from a demand to a supply zone, right? One example I'll show you for that is this one, right over here. You see this drop, there's so many basing candles and then a rally. So this is a pretty bad, ugly demand zone, but still we can consider it as a demand zone, right? Price breaks this demand zone, doesn't even work for the first time back, comes down till here. Now it enters back, it goes back to the zone. The zone flips its nature now. So from demand, it becomes a supply. And then it reacts for the first time back. Then again it goes back in, again reacts strongly. Second time back, then again third time back, and again fourth time back. So you can see how this demand became supply, a strong supply, and how price reacted again and again and again. Yes, you can also observe this, that while prices went back in and dropped from here, you can also consider this as a new supply zone getting created at an area which previously behaved as a flip zone. Right, so this was also the first example that we had drawn, the supply zone. Okay, so this was basically after the demand zone break, it acted as a flip zone over here. Second time back, it again acted as a flip zone and created a fresh supply zone here, which again reacted. Right, so demand changing its nature to become a supply, and supplies changing its nature to become demands are called flip zones. So remember, it becomes flip only after the original zone was completely broken. And you will be able to witness this phenomena across time frame. This is not just for the daily time frame. It works on weekly, monthly, of 1 hour time frame, 15-minute time frame, 5-minute time frame, even the 1-minute time frame. So like, as we know that price is fractal in nature, and we have learned this particular concept repeatedly in previous videos as well. So we know that demand and supply zones work across time frames. Similarly, even flip zones and its behavior can be witnessed across time frames, right? In traditional technical analysis, there's something called support becoming resistance and resistance becoming support, right? The SR flip that happens. So similarly to that, we have in our demand supply methodology, we have this flip of nature of the zone also happening. Demand becoming supply after breaking and supply becoming demand after breaking. So this kind of behavior is witnessed. Just to add to some of the reasoning as to why this particular behavior is witnessed, well, there are different schools of thought to it, and I can share you my my understanding of this particular phenomena. So let me go back to this particular example. Let's say this one, the original demand zone that we had drawn. So as you can see, while this demand zone was formed, then it was consequently broken down. Previous to that, if I go back in time like this, let's say I'm here on this date. This is 18th of July, I think. Yes, 18th of July 2019. Let's say I'm sitting on this date. I'm there back in time on this date. So as trader, what do I see? I see to the left extremely good looking a bullish uptrend, right? So prices consistently making higher lows, and if you see this entire price behavior starting May, June, and half of July, it's a strong uptrend, right? So basically, traders will start adding to their positions, to their long positions, while demand zones are happening. While this kind of behavior uptrend is happening. So they might consider adding some positions here. They might add some more positions here, then they might add some more positions over here. And in traditional technical analysis, and most of the training schools of stock market will always teach you to keep your stop losses below either swing lows. So if I delete this zone, you can see that this was the last swing low over here, this candle, and this was the last swing high, swing low, then swing high, swing low. So it's making a higher low kind of a uptrend scenario, right? As per traditional technical analysis view. So as per that view, the last sort of swing low is this one, this swing low, right? So normally the traditional technical analysis books, the teachers, the trainers, they always teach this kind of a method, which you're aware, I'm sure. They'll always trail your stop loss back to the last pivot low, right? Or sometimes candlestick traders always keep their stops below that candlestick pattern formation, right? These are very two common areas of stop loss keeping. Below the last pivot low in case of long positions or in case of building on an uptrend, and keeping your stop losses above the last swing high in case of a downtrend. So this is normally what is taught in schools per se. So therefore most trend traders who want to ride this particular trend, ongoing uptrend happening, they tend to keep on buying and keeping the stop losses below over here in this particular swing low. Now what happens is that market suddenly breaks this swing low and takes out their stops, right? So, and not every trader will keep their stop losses, right, in position over here. Some do, some don't. People who had, in disciplined manner kept their stop losses over here, they were basically stopped out of their long positions or while they were riding this uptrend. But not every one of them, not majority of the traders, if you have witnessed, it's very hard psychologically to take stop losses or keep their stop losses planned, put in place in the system right there. So what happens is that a lot of traders who are basically, they are into this uptrend, they are not desperate after the swing low is broken, and as per their trading system, the trend is like over, or their stop losses has been breached. Their intended stop loss point has been breached, right? So now what they do is, after this day happened, now they're desperately waiting to reverse their positions when price comes back to their intended stop loss area. So this was the original stop loss area, right? Over here. So once price starts retracting it back to that particular stop loss area, or towards the end of that zone, or towards that swing low, since they were long, now they will start selling to close their positions. So they keep their sell orders over here, right, where the intended stop loss position was. So there becomes this particular place becomes a hotspot for sell orders, particularly stop loss orders, because of which a strong supply order flow comes over here. And I've always maintained that it's not the institutions, it's not the retailers who drive prices in the market prices, but normally it's the institutions that do that. And witnessing this kind of phenomena for quite some time over the years, I have a feeling that it is not just the retail traders who do this kind of behavior, but I think it's also the professional traders or the HNIs or the large traders, if not the very big ones, even the small size or mid-sized, the wealthy traders, they also do this kind of a behavior. I don't know if they use the algos, and that algo tries to exhibit this kind of or mimic this kind of behavior. That when price returns back to such an area, which I just explained, where they were like riding the uptrend, and then suddenly that critical sensitive point got breached, which gives them a signal that the trend is ending, price would often come there and retrace from there like this. It came back here and then retraced back from here. So this happens mainly because of a deluge or a heavy quantity of sell orders placed here, right? So there could be multiple reasons for this. One hypothesis is that it's because of these traders who are like stuck when this strong reversal happened, and their stop losses got, I mean, the intended stop loss point got taken out, and now they really want to come back and place their sort of close orders or reverse sell orders over here, because of which a strong cluster of sell orders builds up over here, because of which when price revisits that, it acts as a flip zone, like opposite nature, right? So this is one kind of one side of the story. The other side of the story is that when the last swing high gets sort of broken, the trend is supposed to be like ending, right? So now it's printed the lower low compared to this low. So what happens that the aggressive sellers or the aggressive short sellers who want to enter fresh short positions into the market, they also start, keeping their short positions once this reversal happens. Because if price goes up, they get a better, higher price to sell. So even their orders add up to the stop loss orders of the original long position traders, and then thereby creating a gamut of sell orders at this particular area. Because of which, when price returns back there due to this huge cluster of sell orders, price is again pushed back on the downside, right? And this could happen for multiple times as well, depending upon, we can't say like who was in this uptrend, or we know that, I mean, if you have seen the interview of very famous, the so-called Warren Buffett of India, not naming the person, but of course, you would have understand whom I'm referring to, the so-called Warren Buffett of India. In one of his interviews, I remember some years ago, he said that he's not only an investor, the big bull, he's also, a trader himself. And he likes to add to positions when a particular stock is in a strong trend on the upside, right? So he did say that in one of his interviews, if I remember. This interview was to one of the CNBC anchors, popular CNBC anchors, not naming that person again. But yeah. So even if the big bull, with his crores of portfolio, even if he's trading, you can imagine that the quantity he's using to trade as well. And it's also not a hidden fact that institutions not only invest, there's some institutions who trade as well for short terms, right? And this is also well known. So we can understand that as well. So hopefully the concept of flip zones has been clear to you. And I mean, we can leave aside these sort of background things that I just explained right now. It's just for the people who are enthusiastically thinking that, what could be the reasons for zones flipping and changing polarity. So there are different hypotheses to this. Which one is exactly for sure, no one can tell, right? This is the thing with the markets. But the thing that is important is that how it is behaving, like whatever be the reason. The fact is that zones do behave as flip zones. This is a fact. And this can be observed on price chart. So just go with that, right? So try to familiarize yourself with the concept by going to the charts, different charts, and just see how this kind of behavior is, happening. So if you see over here, this was again a nice supply zone. This rally base drop in this particular downtrend. Let me draw this base to wick. This was a supply, and supply reacted here when price visited for the over here. Sorry, this was, if I take wick to wick, then this was the first reaction, second reaction, and then eventually it broke, right? This particular supply zone. and it broke this day, closed here, price reversed back to this zone, and then it went up from there. Price again came very close to the zone and then again reacted from there. So you can see this particular behavior happening in charts across time frames over and over again. And flip zones and zone swapping is an important advanced concept that all demand supply traders should know. And if someone ignores this particular concept, you are ignoring a very big part of price charts. So never ignore flip zones, zone swapping, or SR flips, that is support, resistance being support, right? So these concepts should not be ignored because these keep happening over and over and again. And attached along with these flip zone concept is other important concepts which we'll cover in future. So for now, just be aware that this kind of phenomena happens in the market, and I'm sure you must have observed as well. If not, go back to the charts and just observe this by opening your own chart terminal on your terminal and then witnessing this kind of phenomena. So that's all for this video, and it's also an important, advanced, vast topic. There are more intricacies to this flip zone concept. It appears very simple. It is simple, but there are more advanced factors that we can apply while using flip zones, along with the stuff that we have learned so far. So please be aware of this concept. So that's all for now. I'll come up with another video shortly. So until then, have a happy, safe trading and enjoy the winters. Thank you so much.